Good evening from New York. It's 5:53 p.m. on Wednesday, April 1st, 2026. Welcome to the Lynx Data Insight Market Briefing. This analysis is AI generated by Lynx Data Insight and is for informational purposes only. It does not constitute financial advice. Markets are closed for the day. And what a session! Oil cracking below the $100 handle, equities rallying across the board, and a presidential national address on Iran scheduled for 9 p.m. tonight. Let's unpack all of it.
Let's get right into the numbers. The S&P 500 closed at 6575.08, up 0.71%. The Nasdaq led with a 1.17% gain to 21,842.59. The Dow added 0.48% to 46,564.20, and the Russell 2000 gained 0.64% to 2512.36. The VIX sits at 24.53, still elevated but off recent highs. The 10-year Treasury yield is at 4.32%, the 2-year at 3.61%, giving us a yield curve spread of 71 basis points, a normal, positively sloped curve. Breadth was modestly positive at 279 advancing versus 230 declining. This is a headline-driven, geopolitically anchored market regime. Today had two overlapping catalysts. First and foremost, the sharp decline in crude oil after President Trump indicated the Iran conflict could wind down in 2 to 3 weeks. And second, a cluster of AI semiconductor strength led by storage and memory names that dominated the top gainers list.
So let's start with the oil move, because according to CNBC, WTI May delivery settled at $100.12 a barrel, down 1.24%, and Brent June delivery dropped 2.82% to around $101.04. That's a dramatic pullback from where Brent settled on Tuesday at $118.35. But the Strait of Hormuz is still effectively closed, and Iran's Revolutionary Guard is threatening to attack 18 named U.S. companies in the region. How real is this de-escalation?
That's the core tension. The price action reflects hope, not confirmation. Trump said Tuesday evening, quote, "We'll be leaving very soon," and the White House is scheduled tonight's 9 p.m. national address to provide what they're calling an important update on Iran. Markets are pricing in a credibility premium for that address. If he delivers a concrete ceasefire timeline and the Strait of Hormuz begins reopening, you could see WTI collapse another $20 per barrel within days. But as of right now, the strait remains closed. Iranian drones hit fuel tanks at Kuwaiti International Airport today, according to Kuwaiti media. And Iran's foreign minister told Al Jazeera that exchanged messages do not constitute negotiations. So we have words moving in one direction and kinetic activity moving in the other. The market chose to believe the words today, but the VIX at 2453 tells you nobody is all in on this thesis.
And this oil move isn't happening in a vacuum. We got economic data today that complicates the picture. ADP private payrolls came in at 62,000 versus 39,000 expected, and the ISM Manufacturing Prices Index surged to 78.3. That's the highest since June 2022.
That ISM prices print is the number that should keep every portfolio manager up tonight. Manufacturing activity itself is healthy at 52.7, so the economy isn't rolling over, but input costs are accelerating violently. A 7.8-point surge in a single month tells you the war-driven energy shock is now contaminating the manufacturing supply chain. Here's the causal chain. The Strait of Hormuz closure pushes crude above $100, which raises transportation and input costs for manufacturers, which shows up as a 78.3 ISM prices index, which feeds into producer prices and eventually consumer prices, which, according to AAA data cited by CNBC, is already showing up at the pump, with a nationwide average of $4.01 per gallon, the highest since August 2022. That's a direct tax on the consumer and a stagflationary signal the Fed cannot ignore if it persists.
Which brings us to the critical question: what does all of this mean for the Fed's rate path?
The 2-year yield at 3.61% is sitting right at the Fed funds proxy of 3.61%, which tells you the market expects the Fed to hold exactly where it is. There's maybe 2 cuts loosely priced for the balance of 2026, but that ISM Prices Index just made those cuts less likely. Here's the key distinction, though. The Fed typically looks through energy-driven headline inflation unless it feeds into core measures or inflation expectations become unanchored. We're not there yet. This war has only been going on for about a month. But if oil stays above $100 for another quarter, you'll see it bleed into core goods inflation through transportation surcharges, packaging costs, and petrochemical inputs. The 10-year at 4.32 with a spread of 71 basis points over the 2-year says the bond market sees growth holding up, but inflation risks tilting higher. Bottom line, the Fed is frozen through at least mid-2026. If Trump's address tonight credibly signals a ceasefire and oil collapses, the rate cut window reopens. If the war drags on, those cuts get shelved indefinitely, and the conversation shifts toward whether the next move could be a hike.
That's a stark fork in the road. Let's talk about who wins and who loses from today's session, because the gainers list was dominated by a very specific theme.
Absolutely. 5 of the top 10 gainers were technology names, and the sector clustering tells a very specific story. This was a memory and storage rally tied to AI infrastructure demand. Seagate led the entire market, up 6.8%. Intel jumped 6.67% on the $14.2 billion Ireland fab repurchase. SanDisk gained 6.15%, Western Digital 6.13%, and Micron 5.24%. That's not random. These are companies directly levered to data center build-out and the emerging CPU bottleneck that NVIDIA itself has flagged. The shift toward agentic AI is driving demand for general-purpose compute, not just GPUs, and Intel CFO David Zinsner explicitly tied the Ireland repurchase to, quote, the growing and essential roles CPUs play in the era of AI. On the consumer side, Lululemon popped 5.15% on de-escalation hopes, a pure sentiment trade in beaten-down consumer discretionary. Now, structurally, the sector breadth data paints a much more interesting picture. Energy has 100% of its stocks above the 200-day moving average. Every single name in a $2.32 trillion sector is above its long-term trend. 0 stocks near 52-week lows. That's extreme bullish breadth driven entirely by the war premium, and it's the sector most exposed to mean reversion risk if a ceasefire materializes tonight.
Wait, if energy has 100% of stocks above the 200-day average, what does the other extreme look like?
The mirror image is devastating. Real estate has nearly 42% of its stocks sitting at 52-week lows, with only 16% above the 50-day moving average. That's a $1.11 trillion sector in structural distress from a 4.32% 10-year yield. Financial services, $7.57 trillion in market cap, has only 7% of stocks above the 50-day average, with almost 16% near 52-week lows. Consumer cyclical is similarly broken at 13% above the 50-day, with only 4% near highs. And here's what's striking about technology. Despite Intel and the storage names leading today, the broader sector has only 27% of stocks above the 50-day and 22% near lows. The Magnificent Seven are masking extreme internal weakness. On the flip side, utilities have 71% of stocks near 52-week highs, with 0 near lows. That's classic defensive crowding in a risk-off environment, amplified by AI-driven power demand.
On the loser's side, Nike was the big story, down 4.15% after Goldman, JP Morgan, and Bank of America all downgraded it. But what caught my eye was that this connects directly back to the macro picture.
Nike is the compound pressure trade. The triple downgrade came after management guided for sales to remain negative through the end of calendar 2026, with China sales expected to plunge 20%. But listen to what Nike CFO said on the earnings call. He explicitly warned about unplanned volatility from, quote, the disruption in the Middle East, rising oil prices, and other factors that could impact either input costs or consumer behavior. Nike's gross margin has declined year over year for 7 consecutive quarters, and now rising petrochemical costs from the war are putting additional pressure on product input costs. This is the second-order consumer effect. Elevated energy prices squeeze discretionary spending while simultaneously raising costs for the companies selling into that weakened consumer. Elsewhere on the loser's side, Lamb Weston dropped 7.32%, food sector under pressure from input cost inflation. Alexandria Real Estate fell 6.9%, rate-sensitive REIT crushed by the 4.32% 10-year. LyondellBasell lost 4.11%, basic materials getting hit by rising feedstock costs.
Let me pivot to corporate signals, because Intel's fab repurchase and the Eli Lilly FDA approval both connect to structural themes. Intel is spending $14.2 billion to buy back a stake it sold to Apollo for $11.2 billion less than 2 years ago. That's a significant premium. What does that signal?
It signals the CPU renaissance is real enough for Intel to pay a $3 billion premium to reclaim full ownership of manufacturing capacity. The Futurum Group is calling it a quiet supply crisis, predicting CPU market growth could actually exceed GPU growth by 2028 as agentic AI shifts compute demand toward general-purpose processing. Intel's strongest demand right now is for its Xeon 6 server CPU, manufactured at that Ireland facility. This is the structural case for semiconductor investment beyond NVIDIA, though NVIDIA itself was essentially flat today, down just 0.11% intraday, still trading below both its 50-day and 200-day moving averages, with a year-to-date loss of 6.93%. The Eli Lilly story is different but equally structurally significant. The FDA approval of Foundeo, their oral GLP-1 pill for obesity, at a cash pay price of $149 to $349 per month, puts it in direct competition with Novo Nordisk's Wegovy pill. Analysts estimate Foundeo sales reaching nearly $15 billion by 2030, according to FactSet. For the healthcare sector more broadly, this expands the addressable market. Novo has reported over 600,000 prescriptions in March alone for its pill, and early data suggests oral formulations are drawing new patients rather than cannibalizing injectables.
Let's stress test this. What's the risk case investors should be gaming out, especially ahead of tonight's address?
Our base case, which we'd assign about a 55% probability, is that Trump's address tonight provides enough rhetorical de-escalation to maintain a near-term floor for equities and a ceiling for oil. In that scenario, the S&P trades in a 6,450 to 6,700 range over the next week. The 10-year yield holds between 420 and 445, and WTI oscillates between $92 and $108. The Fed holds through June, and the market grinds higher on hope while waiting for verification. The risk case, 30% probability, is that tonight's address fails to deliver a credible ceasefire timeline, or the war escalates from here. Iran's Revolutionary Guard has explicitly threatened to attack 18 named U.S. companies in the region, including Google, Microsoft, Apple, Intel, Tesla, and Boeing. If the Strait of Hormuz remains closed and Iran follows through on those threats, oil breaks above $120. That ISM Prices Index, already at 78.3, would accelerate further, crushing consumer sentiment, forcing the Fed to shelve rate cuts indefinitely, and potentially putting hikes back on the table. In that scenario, the S&P could test 6150, and the 10-year pushes toward 455 as term premium reprices. The upside tail, 15% probability, is a concrete, verifiable ceasefire with a timeline to reopen the strait, confirmed by Iranian diplomatic channels. That collapses the oil risk premium by $20+ per barrel within days, compresses the VIX toward 18, and unleashes a broad rotation into beaten-down cyclicals, consumer discretionary, and travel names. The S&P could push toward 6850 in that scenario.
Given those scenarios, how should investors actually be positioned?
Highest conviction, maintain energy producer exposure, but begin tightening stops. 100% of the sector above its 200-day average is historically extreme, and a ceasefire would trigger violent mean reversion.
You want to own energy heading into tonight's address, but you need to be ready to sell into a ceasefire confirmation. Secondary conviction: gradually accumulate high-quality semiconductor names tied to the CPU and storage buildout. Intel, Micron, Seagate. On any pullbacks, the AI infrastructure demand cycle is structural and independent of the war resolution. Tactical hedge: if the VIX pulls back toward 22 on post-address relief, buy put spreads on the S&P. The headline risk hasn't evaporated even in the base case. Avoid list: rate-sensitive real estate. With 42% of stocks near 52-week lows, there's no floor until the 10-year decisively breaks below 4%. Also, avoid consumer discretionary names with high international exposure. Nike's triple downgrade is the canary in that coal mine.
How does it all fit together?
When you step back, this is really about a market trying to price in the end of a war before the war has actually ended. Oil below 101 on Brent, equities rallying, storage names surging on AI demand. All of that assumes the geopolitical risk premium is about to deflate. But the ISM prices index at 78.3, gas at $4 a gallon according to AAA, and the Strait of Hormuz still closed, those are facts on the ground that contradict the optimism priced into equities. The cross-asset signal is telling. Equities are pricing in de-escalation, while bond yields haven't meaningfully declined, suggesting the fixed income market isn't buying the optimism wholesale. That disconnect will resolve. Either oil collapses and bonds rally, confirming the equity bet, or oil re-accelerates and equities give back today's gains. Tonight's address at 9 p.m. is the catalyst for that resolution. Now, the bull case is genuine. If Trump delivers something concrete and the strait begins reopening within weeks, the relief rally would be enormous. We could see the sharpest compression in energy prices since the Russia-Ukraine ceasefire in 2023, and every beaten-down sector, from financials to real estate, would catch a bid. Microsoft at $369.45, down 21.72% year-to-date, and trading well below both its 50- and 200-day moving averages, with any broad risk-on rotation. The magnitude of the potential move is why you don't want to be completely de-risked heading into tonight.
Give us 3 takeaways to send listeners home with.
First, the risk. Tonight's national address is a binary event. If it disappoints, oil re-accelerates above 110, and the ISM prices signal starts feeding into broader inflation fears. Non-farm payrolls on Friday would then be the next catalyst for a potential repricing of the Fed path. Second, the insight. Broad tech is far weaker than the headlines suggest. Only 2.47% of technology stocks are near 52-week highs, despite today's storage-led rally. The sector's internal breadth is deteriorating even as Intel and Seagate surge. Don't confuse single-name strength with sector health. Third, positioning. The asymmetric trade right now is owning a barbell. Energy producers with tight stops on one side and high-quality semiconductors on the other. Both benefit from different versions of the future, and the one thing both scenarios have in common is that AI infrastructure demand doesn't depend on whether Trump delivers a ceasefire or not.
Thank you for listening. This is Lynx Data Insight, and we will be back tomorrow with your next market briefing.